What's going on? Today I'm going to be doing something a little bit differently. Normally I don't share my one-on-one calls with my students, but this one was way too valuable for me not to post. The student you're about to see has only been trading for less than a month. He's a complete beginner, but he's already grasping all of the core concepts that I have been teaching him. During this call, he asked me a very powerful question. Andrew, how do you mark up your charts? How do you know which PD arrays, which fair value gaps, which order blocks that I should specifically be looking for on my charts? So in this session, I broke it down step by step, exactly how I keep my charts organized, from the right highs and lows marked out to the right order blocks and right fair value gaps and all other PD arrays. If you've ever been confused on exactly how to structure out your charts, this video is gonna be for you. Let's get right into it.
Okay. Cool. So I'm going to go ahead and mark out a few things. So we have, the first thing we're going to mark out is going to be New York midnight opening price, which is going to be right here.
Midnight opening price?
Yes.
So literally like 12 o'clock a.m.
Correct.
East News.
Correct. It's a measure of premium and discount. So, and then we're going to mark out 1800 opening price. 1800 is going to be the true day open, which is where the new daily candle forms.
1800, is that like, that's 9 a.m.?
1800 is 6 o'clock p.m. from the previous day. You should know this already. If you're watching the videos, it's all in there. I talk about this every time I have a video.
Yeah, so during the videos I heard you mention like 1800, so then you'll be like, I don't want to see price go below 1800, let's say, right?
Yeah.
I'm just looking at the chart. I'm like, bro, what 1800 are you guys talking about, right? And then I'll look over at the right. I was like, I know it's not the price. I look down, and then I see all the times there, but then
1800. Look, if you look at the bottom, 1800 is 6 o'clock p.m. because it's in military time.
All right.
You get it? Okay, so I'm marking out a few things on my chart. Okay. So I marked out 8:30 opening here just so that we can just to see that, just to be able to differentiate. And then we had this was London high. Yeah, London high was right here. Let me actually just use this instead.
So can you mark this same point, whether it be on a 5 minute or 1 hour or whatever?
Yeah. I'm using the 5 minute just because, but.
Okay, right there, when you mark London high, right?
Mm-hmm.
The wicks on the right, where that blue line is going through, those ones are higher.
Which ones? This one?
Yeah.
But these aren't during London.
Okay. That's London close. All right.
Well, it is. No, it's not. London kill zone is between 2 and 5. So 2 and 5. So, 2 and 5. Okay, so if you look right here, okay, I want to explain something, okay? How did I know that we were going to push up higher? Because this was Asia high too. Asian high was right here. Okay, so we had Asia high right here.
Okay.
Notice what we did here. And this is how you're developing narrative, okay? We came down during Asia. We took out this low, sell side.
Okay.
Sell side liquidity is right here. We then displaced up higher above.
That vertical, that vertical line right there, that first one,
This one?
right next to sell side,
This one?
just on the chart, like that big ass gray line.
This one.
Is you right there? Yeah, this one. That's
Separating the day. That's
the day.
That's the new day. That's Monday at midnight.
Okay. That makes sense. Right.
So we take out sell side here. Okay. Now notice what happens. Price pushes up. We come down. We fail to take out this low and we push up. Okay. This is technically a market structure shift right here, but I'm not going to count this one. I'm going to count this one because this is the high that initiated this run down. Okay. So once we break this structural high here, because it's the high that put in the new low beneath sell side, I'm now expecting price to come up into Asia high. Why? Because we've shifted in market structure. There's been a shift. We were seeking sell side. Now we've broken structure to the upside. So if I were to take a line, okay, a line tool, it's going to look like this. and I were to remove this, notice what happens here. We come down, we come back up, we come down, we come back up, we come down, but then we break through this high. Okay, so we broke through this high right here. We now come back down into the new range from this low up to this high. Now I'm expecting the original high to get taken. Does that make sense?
Okay. Yep.
Okay, cool. So this is like, imagine you got to your charts, like you're at your charts at, I don't know, 8 a.m. Okay, so like right now, this is all you see. So you're probably asking, okay, like how can I determine which direction we're going in? Okay. Also notice here what happened. Just based off of, you know, this reaction here, yeah, we're in a premium. If you take the fib, hold up. If you take the fib from this high down to this low, we're above the 50% right here.
Yep.
So that means that we're in a premium. So because we're above 50%, technically we could come down. Okay. But I would like us to continue up. Now, what's the area of invalidation for buys if we take out this low right here? Because this low swept liquidity and shifted. This low right here is responsible for a sweep of liquidity and a shift in market structure. So this now becomes a protected low. Whenever there's a protected low, you don't want to see price violate that protected low if we're going to continue in that direction. Okay, so right now, price pushes back up. As it's coming back down, okay, that is when you can start looking for entries. Now, obviously, this is during London. I wouldn't recommend trading London, but the way that you do it is this. You mark out, okay, the new range from this low to this high, okay?
Okay.
You mark out this range. Now you want to see, okay, where's the 50%? The 50% is right here. 50% is right here. You want to find any PD arrays within the 50% underneath it in the discount. What do we have here? A fair value gap. This is how you avoid picking and choosing a bunch of different fair value gaps. Because look at this. There's another fair value gap right here. But why does this one get disrespected?
Because it's above the 50%.
Exactly. So you're not looking to take an entry off of here.
Okay.
As it's coming down here, you're expecting this to get ran through because it's above the 50%. And then also notice what we have here. We have internal range sell side resting right here. That's another...
Internal range sell side. So sell side liquidity is when, like, sell side is just when the sell orders get filled, so that because people want to buy these shares, right?
Yeah, sell side is just resting sell stop orders. Okay, so if people bought here in this specific area, they would put their stop losses here. So liquidity gets built up here, typically rested beneath equal lows. So we have equal lows in the discount of the range close to the 50%, but slightly underneath it with a fair value gap under it. This is like a double confirmation that these lows are going to get taken and that this fair value gap is going to get traded to. So personally, I would not be getting into any trades to go higher until price takes out this sell side liquidity. So a trade that you can take is off of the fair value gap right here. Again, obviously this is in London. You wouldn't be taking this trade in London, but assuming that it's during the times where you would trade, you would take this trade right here, okay, off of, I would prefer to have it off the open because the sell side is right here. Because the sell side is so close to this fair value gap, I'm not really expecting price to come deep into the fair value gap. I'm expecting it to barely sweep the sell side and then reverse. So I would have my entry at the opening of it, and then my stop loss would be beneath this point right here. I don't really expect it to come back down into this wick, so that's just adding unnecessary risk. So I would just keep my stop loss here, and then I would be targeting this high right here, and that would be my target, and that would be my trade right there. Okay, and I would just either manually enter as it's hitting here, or I'd have a limit order right here set, expecting price to reject out of this area and push up higher. Notice how we didn't look at any other PD arrays other than this fair value gap and this liquidity. There's also an order block right here, but it's not really clean on this time frame. If we go to the 15-minute, you can see it's a bit better. Okay, notice what I said earlier as well. You want to see, okay, so look, actually, if you go to the 15-minute and make the fair value gap according to the 15-minute, we actually do hit the 50% of the 15-minute fair value gap. But notice what I said earlier. Whenever you see a fair value gap paired with an order block, that's a great combination. There's this order block right here that we tap alongside this fair value gap that we trade into. Boom. You take out these highs. That's a amazing trade. A+ setup right here. We swept liquidity. We broke structure. We came back down into the discount of the range. You enter your trade. You target the first high. Easy, simple. Now look, continuing with this. Assuming that you didn't take this trade because you were asleep, okay? Where can you expect now? Okay, look, so we took out this high, okay? But this is still our structural low, and we haven't yet broke above Asia high. So because we haven't yet broke above Asia high, okay, we can now move our fib to this high. Okay, because this is our new structural high as opposed to this one because we broke and closed through, but we still haven't taken out this high yet. So until we take out this high and close above it, I'm not going to drag my fib any higher than here. This is the highest high. Okay, so because we now failed to take out Asia high, okay, and we've broken down to the downside, that doesn't mean that we're going to come down and take out this low because I'm still expecting higher prices. It just means that price needs to come back down into a discount again before pushing up and taking out Asia high. So what am I going to do here? I'm simply going to wait. Okay, we have this fair value gap right here. It's technically now in the discount. Half of it's in the discount. Okay, but we still have this fair value gap right here as well. And I would prefer for us to trade into this fair value gap, but because this wick right here took out the sell side liquidity, this now becomes a protected low similar to this one. So I don't want to see this wick violated. The low of this wick needs to stay intact if we're actually going to push up higher. So let's just play price right here. Okay, boom. Price starts to push down. Okay, right as price pushes down into this fair value gap that we have outlined, again, because we're expecting price to push up higher, you can just enter right here. You just enter. Your stop loss again goes. You could have it here for a tight stop, but again, the safer stop loss is again the same one as last time. And then I'm going to be targeting Asia high, and that's my trade. Okay, and then you can see here how boom, it just plays out wonderfully, boom, right there. And then it continues to rip up higher. And then that's the trade right there. And then if you decide you want to hold beyond, then you're going to look for any other targets. A target that you can use here is this fair value gap, but then also look what we have here. We have this order block. And then notice here, right as we hit this order block, right there, we got a rejection. See these wicks? We got a rejection off of this order block because it's going to offer some sort of resistance. Now, it's not going to offer us a resistance or a reaction to push us all the way down. It's simply going to offer us a reaction into the opposing PD array, which in this case, it's going to be this black candle here that makes up an order block. So it's just literally going to bounce from one PD array to the next PD array to then push us up higher. And then I would be getting out here at this final target. Boom. And then you can see how it just kind of bullshitted the rest of the day before we just dumped back down. But that would have been the trade. That's actually the trade that I took, and I made 4,500 on my top step evals today. I caught it from here. I didn't even hold it to the entire time. I think I got out like right around here because I was in with 4 contracts. So this was a beautiful trade right here. A+ setup built off of this narrative.
So what are the main like things that you're looking for? Like, I know you're not necessarily looking for all these different type of PD arrays. Like in your streams, you're mentioning order blocks a lot. You're doing obviously like your fair value gaps. And then I've also seen like you tend to talk about a lot of like equal lows as well, equal lows and equal highs.
Literally everything I just explained, bro. Literally everything I just explained. My majority of my trades, bro, come off of premium and discount of ranges and just waiting for reaction. So like, just like I explained, like, do you understand the narrative that I just built? I just built an entire storyline for you. Okay?
Yeah.
This is what's going to help you get into your trade. Then I can get in off anything. Let's just say I missed this entry right here off of this fair value gap. Another entry's right here. Now, why is it this entry right here? Let me delete this. Why this entry? Okay, and where's my stop going to be? If I entered right there, my stop loss is going to be here. Why this entry? Okay, this entry, because right as we push through this down close candle right here, that was a change in the state of delivery. Okay, that now becomes an order block. Okay, so an order block is formed. So as price displaced through it and came back into it, also notice what we have here. A small little fair value gap right here.
So that's a double confirmation that we're going to continue up higher. Let's just say you missed this entry right here. Where can I get in? Right as price is pushing through the body of this candle, I can expect this to now have another change in the state of delivery. So I would be entering upon price pushing through here. Where does my stop loss go? Beneath this low right here. Now, why does my stop loss go beneath this low? My stop loss goes beneath this low because we swept liquidity right here. This low now becomes a protected low. This is a protected low. I don't want to see price come back down here, especially because this is the wick that rejected off of this order block. I want to see continued higher prices. Now, let's just say you missed that entry too. Where are you getting in? Off of this order block. Stop loss goes beneath here. Okay, let's just say you missed that entry as well. Where are you getting in at? Right here, again, at this order block. Okay, and where are you targeting? You're targeting this high. Okay, the reason why
one's the order block?
This black candle right here is an order block.
All right.
Okay, so price comes back down into the order block. You enter off the order block. You target the next opposing high right here. Boom, easy. A+ setup right here.
Okay.
Today was a textbook day. Like today was one of the best days I've seen in a minute.
All right. What kind of things are you looking for that would make you not want to take the trade?
Great question. Great question. So in this instance right here, if I'm expecting higher prices and we push straight through this fair value gap and get a close through it, and we get really close to this low, I'm probably not taking any longs anymore.
What if like you see that candle you marked out that just kind of tapped the 5-minute fair value gap? Do you have it like underlined with that little loop?
This one?
That's
Oh, this one right here, yeah.
Yeah. You see how it's like just a wick? Like, would it change anything if the body closed in that fair value gap?
No, it wouldn't. As long as we didn't close entirely too far beyond the bottom of the fair value gap.
Okay. All right.
So the reason why I wouldn't take a trade in this narrative right here is simply if we would have violated this low right here. Because if we would have violated this protected low, I'm no longer expecting price to push up. Okay? But because this low stayed intact, I'm expecting price to continue to push up. Okay, another example. Okay? If price pushed through this order block right here,
Even if it's just a wick?
no, I'm saying if we push through, like if we violated the low of this candle
Okay.
right here, I would not be looking, like the fact that this down close candle came and then just stopped is telling me we're likely going to respect it. So I'm going to get in right there. I'm pulling the trigger all day long. That's for me. I'm taking this trade every day of the week. If this trade could form every day of the week, I'm rich. I'm making millions of dollars a year. This one setup right here is all you need to never work a day in your life. Literally. A++ setup. We literally come down into the order block, reject out of it, boom, straight to TP. No hesitation whatsoever. Like this is just an amazing trade. Right here. And notice, everything that we just did is off the 5-minute. I didn't even drop down into the 1. And sometimes, like, bro, you might get jaded on the 1. Like, the 1 minute here just looks so ugly, so messy. So it's best to just stay on the 5. If you're having problems with entries, anyone listening, stick to the 5-minute. The 5-minute will make you money. Okay? And it's going to eliminate that impulsiveness that a lot of us have, even myself included. A lot of times I find myself extremely impulsive. But when I go to the 5-minute chart, man, my entries they might not be the most precise, but my win rate is a lot higher when I'm on the 5-minute. A lot higher. Because there's less trade opportunities. I'm not trying to take every little thing that forms. Okay? Today was just a beautiful day. If you made it this far in the video, I can tell that you're actually serious about leveling up your trading and finally becoming a consistently profitable trader, okay? You can be exactly like my student who literally started less than 1 month ago and is already on track to quitting his job and getting his first payout, okay? If you feel that you can be the exact same, okay, there's gonna be a link down in the description below for you to apply. Again, I'm only here to take on the most serious individuals. There is going to be a 4-figure investment, and I don't want you to think about it as you spending or wasting money, okay? Think about it from the perspective of, I'm putting in X amount of money and I'm going to be making X amount in return, okay? This is an investment in your future self. You are taking the time and the energy and investing into your education, investing into your future success. Again, I'm only here to work with the most serious individuals. If you think that you're serious enough to work with me, then go ahead, click that link down below. If you enjoyed this video, leave a like, go ahead and comment, and subscribe if you want to see similar content to this. Let me know what you guys think of this video, whatever you guys want. If you guys want me to create more content like this, comment down below what you guys want, and then we'll go from there. I appreciate you for watching this video, and I'll see you guys in the next one. Peace.